Everyone talks about why you should start investing early, but no one really tells you that what can go wrong. It sounds great on the surface, but if you are not careful, starting too soon can actually lead to some serious financial consequences, especially if you are dealing with low income or just getting started. Let us break down why investing early is not always the best idea for everyone. Imagine this: you are in your early 20s, excited to jump into the stock market and decide to throw all your savings into it. A few months later, you lose your job or something unexpected happens, like a major medical expense. And now you have no emergency fund and no stable income. You are forced to sell off your investments to cover your costs. This means you are probably selling at a loss, wiping out any potential gains you could have made. Even worse, you're left without any financial cushion for the next emergency that life throws at you. Investing early can actually leave you financially vulnerable if you do not have the liquidity to handle real life emergencies. Most young people do not think about this. They just see the stock market as a way to grow wealth. But what happens when life hits and you need cash right away? And there is another issue of high fees which a lot of people overlook. Say you have decided to invest $500 because, well, everyone tells you it is better to start early than nothing at all. But what many people do not realize is that investment fees can eat away at small portfolios. A 2% fee may sound small, but over time it can wipe out most of your earnings, especially if you are only working with a small amount to begin with. You could end up barely break even or even losing money, which defeats the entire purpose of investing early. Small investments do not guarantee growth. In fact, you might get frustrated seeing your portfolio remain stagnant because of fees and expenses. Early investing only works if your returns outweigh the costs, or for many small investors, they simply do not. Now, another common mistake is taking on too much risk too soon. You are young, so you might think you can handle riskier investments like tech stocks, crypto, or even startups because you have got time on your side. But here is the harsh truth: a lot of speculative investments can tank, leaving you with huge losses early in your investing career. This overconfidence can burn you out or discourage you so badly that you walk away from investing altogether, thinking that it is just a gamble. Early losses can scar you, making it harder to trust investing when you are really need to be learning how to approach it more strategically. One of the biggest dangers of starting early is overlooking other important financial priorities. Let us say you decide to invest, but you have got high interest credit card debt piling up at 20%. You justify the decision because, well, everyone is saying start early, right? But meanwhile, the debt is growing and the return on your investments rarely beats the interest on your credit card. The return on most investments just does not compare to the damage high interest credit card debt do. The misstep can lead you into a debt spiral where your interest payments outgrow any gains you're making, and that can destroy your financial future. You are focusing on wrong priorities. What is the point of growing small investment portfolio if you are drowning in debt? And let us do not forget about the market volatility. Picture this: you're 22 and you invest during a market boom. But then suddenly there is a crash and you watch your portfolio shrink by 40%. In a panic, you sell everything to stop the bleeding. Selling at a wrong time locks in your losses. And most young, inexperienced investors do not have the emotional fortitude to weather that kind of roller coaster. This leads to panic selling and locking in losses rather than letting time work in your favor. A lot of people got caught up in the crypto boom in 2021. Many young investors jumped into the meme stocks and cryptocurrencies without really understanding the risks. Take the example of one young investor who put all their savings into the popular crypto token, thinking that it was a surefire way to get rich. By 2022, the token crashed and he lost nearly everything. Speculative investing without understanding the fundamentals can wipe out all your savings, and these kinds of early losses can discourage people from ever wanting to invest again. Starting early does not mean chasing the next big thing. In fact, it often means you're more likely to get caught in speculative bubbles before you even understand how the market works. So, what should you do instead? Instead of rushing into investments, focus on building a solid financial foundation. Start by creating an emergency fund and paying down high credit interest debt. Without these, you risk being financially fragile, which is far more dangerous than not investing early. If you are in a low income group, investing early might not offer a meaningful returns anyway. In that case, it is better to focus on upskilling and finding better job opportunities. Investing in yourself can give you the capital you need to invest later. You also need to understand your risk tolerance before jumping in. Too many young investors get drawn into volatile investments just because they are young, thinking that they can afford to take the risk. But big losses early on can be hard to recover from, both financially and emotionally. Do not jump in without fully understanding the risks. Finally, avoid short term thinking. Rather than rushing into start early, take your time to understand what long term investments really involves. Starting too early without prior knowledge can lead to bad habits that can persist you throughout the life. Starting to invest early sounds great, but without a solid financial foundation, it can actually set you back. Investing of rushing into it, make sure that you have the basics covered first. No high interest debt, an emergency fund, and a stable income. Once you have a decent salary or a stable income, that is when you should start investing. By then, you will have the financial cushioning and a peace of mind to risk a small manageable portion, say 5% or 10% of your income on investments each month. That is how you're not jeopardizing your financial security and you can focus on growing your wealth strategically with the knowledge and resources to back it up. Remember, it is not about when you start, it is about how you start that makes your investment journey healthier and more peaceful.